Live in the AMs. Can you guys hear the background music or no? Am I just did the joke just completely not land? Can you still hear it or no? This makes no sense. All right, maybe it'll because I think we had the same audio issue last time. So there's something about the Federal Reserve website. It's like when you're trying to stream it, something about the audio messes up, but we'll get right to that. Welcome everybody, another FOMC meeting. We had a stream earlier where we covered some of the recent events. If you guys want to get caught up on what happened in the Middle East, the Hamas assassination and the Hezbollah assassinations, go ahead and watch that stream after this. But today, we're going to be covering the Federal Reserve rate decision. So the FOMC is a small subsection of the Federal Reserve. It's made up of some of their top. It's like three bank presidents or four bank presidents, some folks from the Board of Governors that make up the Federal Open Market Committee that decides on the federal funds rate, which is the interest rate that the Fed charges to banks and within its system. No changes to the interest rate. We talked about this in our prediction stream on Sunday and our prediction stream earlier. The most important topic that's going to be covered today is going to be September cuts. So right now, the Fed futures market is already pricing in almost a 90% chance of rate cuts in September. And knowing Jerome Powell, he's neither going to confirm nor deny, but he's probably going to push it off and say we'll see in the next meeting, depending on how the data looks, et cetera, et cetera. So I don't think he's going to confirm the September cuts. Now, the most important thing is that we've had earnings reports coming out yesterday. I believe Microsoft, AMD, a few others had earnings reports, came out pretty good. So I think that this press conference is going to add fuel to the fire. We're already in this rally, and so I think it's just basically going to accelerate this rally even more. So I'm very bullish on whatever happens here. I don't think he's going to answer a lot of questions, but I really hope they ask him about, because obviously we're going to expect questions about the September cuts. I hope they ask him about the Bank of Japan and the implications that has. I hope they ask him about the second rate cut that Canada did and whether this is the start of a global cutting cycle and whether the central banks are coordinating with each other and what are the effects of that. Because these are some of the topics that I know central banks are focused on, but usually people at home don't care as much. Okay, so let's go to the Fed watch. Just show you guys the probabilities here. Next Fed meeting is in 50 days. That's going to be in September. Probabilities, let's go. Okay, that's today's cut. So now it's actually gone up. There's a 93.5% chance of a rate cut in September. Most important thing is the Fed's number one metric for when they, like if they need to rush to cut rates is employment. That's kind of like their key indicator for recession. We haven't had a sharp drop in employment. I mean, sharp unemployment kind of started to rise up to that 4% mark. But Jerome Powell set those expectations earlier this year. He said we're going to have weakness in the labor market, but that doesn't mean necessarily they're going to rush to cut rates right away. We can expect a little bit of weakness. And so I think he set the foundation for the market to not panic. 93.5% chance. They're definitely going to have to pin Jerome Powell on this. And they're probably going to mention that the capital markets are betting on that 90%. Now, there's also a 60% chance of a rate cut in November, and then another about 50% chance of a rate cut in December. So right now, it seems like one rate cut, September, very likely. As we get closer, these probabilities will change. Okay? Does this make sense to everyone? If you guys want to look at the employment numbers real quick before we get into the press conference, which will be starting in about 10 minutes. Still waiting on this retracement on NASDAQ. Looking to go long, bullish on stocks. Yeah, we've been talking about this recovery here for a bit. Recovery came a bit inconveniently timed, right? Because it happened last night during London, but we can catch the continuation here by being patient and waiting until the press conference. What am I looking for? Oh, Fred St. Louis. Federal Reserve economic data from the St. Louis Fed. Unemployment rate. Seasonally adjusted. So currently, as of June, it's actually at 4.1. Not good. And we did talk about this, that we are headed into a recessionary kind of time soon. Because if you guys look at, let's just look at the 10 years. Oh, maybe not 10. If you guys look at these, every gray area is a recession. So right before we hit a recession, every single time, we typically hit record low unemployment. So we'll hit like, when Trump, right after the COVID spike, we managed to get inflation down to 3.6. Okay, or 3.4 even, which is historically about as low as we've ever gone. 4% as doesn't look as good when you're comparing it to 3.4, 3.5 where we were, but still historically low. So not an emergency for the Fed to go into an emergency cutting cycle. Make sense? So no real reason for the Fed to go to just confirm that, hey, we're going to start cutting right away. There's no real driver there. And so we're just going to have to wait for the next meeting to get the rate cut decision. Unless the world falls apart in the next 2 months, which, the way it's looking, might happen. Make sure you guys drop a like if you're watching this stream so we can get pushed out to more people. And we're going to be reacting. Right now is 2:22. We're going to be reacting in 8 minutes to Jerome Powell hitting the stage. Now, if I can just take a prediction here about what Jerome Powell is going to say in his speech, he said the economic conditions have remained strong. He said unemployment is still historically or secularly low. He's going to mention that the GDP report from last week that came out a bit better than expected. He's going to mention the PCE report, all the inflation reports that came out that have actually been coming out better than expected. Let's look at CPI. Is this sticky CPI? Where is Consumer Price Index, all urban consumers? Oh, gotta find the CPI rate. Oh, okay. CPI rate. Let's do monthly. Percentage change from a year ago, so we're at 4.2% rolling as of June 2024. This is not the right one. Median? No. All right, see, this is why we use Forex Factor. I'm just going to go and look at the data straight up. That's euro. Why is euro on here? Okay. Jobs openings. So the labor report was good. PCE index. Okay, so this one came out as expected, but prices are still going up on a month-by-month basis. Now, this is the one that I think is going to be a big topic And I think this is going to be one of his opening remarks, because obviously Fed loves to take credit for the economy doing well. Not even take credit, but just to point it out, to keep markets from panicking. You guys can see the forecast was a 2% GDP growth in Q2. And then now we're getting 2.8% revision. Now, this is the advanced GDP. So this is the second of the three prints. And then I believe we have one more, which is the final GDP. And that will get revised as well. So GDP crushed it. Prices are still going up. I want to see if we had the CPI print somewhere here. Core retail sales. Retail sales came out better than expected as well. Everyone was expecting a drop-off. No drop-off happened. It actually beat expectations, so that's good. The earnings reports that just came out yesterday and today seem to be pointed in the right direction, so that's good. And then CPI. Okay, so this is the big driver here. And I know Powell's already kind of addressed this, but 3% CPI is actually where we're tracking. That's if you trust the government numbers, okay? And then we actually had the first, I believe, negative. Yeah, this is the first time that we've actually had inflation come down on a month-by-month basis. Core CPI excluding food and energy went up a bit. So it seems like food and energy prices went down. And that was the big driver of what kind of drove CPI from 3.1 down to 3%. All right, so Jerome Powell has a lot to hang his hat on, and he has a lot of data here to support not needing to cut rates immediately. And so I don't think that we can expect him to support, like just to confirm that they're going to do rate cuts. And then he's going to point to all those things in his opening speech, and he's going to point to those as he answers the Q&A portion as well. Hey, Roy, we're not getting notified when you go on live. Bro, what is happening? Now, there's no cursing on the stream. So I'm going to keep it cordial. I'm going to keep it, everything's copacetic. But I have no idea why. Drop a like on the stream. Let's see if it pushes out to more folks. I hopped on YouTube earlier, and it was the top recommended one. It was the, coming soon, live stream starting. So I don't know. See notification settings, bro. You have the Boost Mobile. I don't know what you got, bro. Do you also teach fundamental news? We do. We do. All right, let's take a quick tour in the next a minute and a half before Jerome Powell hits the stage. NASDAQ waiting for this retracement. Okay, if it just pops off and it keeps going, then hopefully my tears don't mess up my computer and we can keep live streaming. But you guys may hear me sobbing in the background. Mind your business, all right? Been looking for this rally for a long time. This happened over London, so didn't have a chance to enter. Waited for a retracement this morning and knew that I had to wait until the Fed meeting. And now I'm here, patient as ever, did everything I was supposed to do. And all the market has to do is just drop down, give us a good reentry. So we'll see. All right. Gold. My gold target is 24.50. The immediate target is 24.32. Let's see. Interesting. So if the market just blows through this zone, okay, then we're going to get a retracement back to this same exact price level and continuation. But because of these equal highs right here, I mean, even though we have already filled a significant portion of this wick, about halfway through, a bit more than halfway, that's a bullish sign. When you're filling a wick to the upside, you're kind of clearing that momentum back the other way. Typically, that momentum continues to move in that direction. But from here, because we're at equal highs, because of the fact that there's a lot of selling pressure in this area, this could be a good place for a retracement down to 2,400 and then continuation back up. So the two options are straight continuation, in which case you go lower time frame, find the retest of the same price, or this thing retraces down to 2,400 and then you take it all the way up to 2,450. Cool. All right, it's 2:30. Let's get the show on the road.
Squarely focused on achieving our dual mandate goals.
Can we have an audio check?
Benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP growth moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period, the first half. Growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%. Job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market have returned to about where they stood on the eve of the pandemic. Strong, but not. Inflation has eased notably over the past 2 years, but remains somewhat above our longer run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Sure he does. Let's see. I know we're going to get to the questions here, but that's exactly what we just said he was going to say. Economy looks great. Let's get to the
A
queue.
rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting.
Come on
The
now.
broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving.
What I say, guys, right? Data dependent. We haven't made decisions about the next meeting. Come on now.
If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you asked why not today? And I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
Howard.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way.
Good question, but good way to
give an
phrase it.
example of cases in which it would be appropriate to cut, and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier, and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
More good data would cause us to gain more confidence. Put that in the history books. Every school, Nobel Peace Prize.
Core inflation at 2.6%.
Economic genius of our time. Just jokes.
At that level in terms of inflation and already beyond what was projected for the labor market. I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say, really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today.
Like we're either going to do no cuts or some cuts, right? Those are the only two choices.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market too? If the labor market is back in equilibrium, why is restrictive policy and potentially very restrictive policy, given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about you know, that we've said in our statement that we're going back to looking at both mandates and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions. And that's what we want to see. You know, we've seen that over a period of a couple of years and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely.
Members, we had a Model 1 right here. I told you right before we got off, like this would piss me off so much if we just hit that Model 1 and dipped off. Now we haven't fully cleared the highs yet, but it does look like the market's just going to be rallying from here and just making a continuation, smaller time frame retest along the way. But patience pays. Let's see if we can get this pullback on the higher time frames and get a much better opportunity to go long.
Inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have two mandates, as you know. The labor market, maximum employment is one, and stable prices is another. So we weigh those two things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be a good single statistic, but we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits, hires, all of those things to determine the overall status of the labor market. But we're looking at it now. I would say again, I think you're
great, solid, honest answers, by the way.
Close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think core inflation was actually running below 2%. So I don't now think of the labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market, and that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those two things are working together, and we're factoring those both into our policy.
Chris.
Chris Rugaber, Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this, and if we see something that looks like a more significant downturn, that would be something that we
Someone's got to ask him what number means significant downturn. What percentage unemployment? So
in terms of I don't think of it that way. I think of it as we're actually in a good place here. We're balancing these two risks of go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates. And I think this is how we balance them. it's a rough balance, but it does feel like that. Again, the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low. And we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low. So it painted a picture of a very static labor market. Is that sustainable in your view, or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected. So that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
Steve Leisman, CNBC. Mr. Chair.
So the maximum employment mandate means they have to maximum
process. And in June, you talked about the idea that, well, one rate cut wouldn't do anything. So I wonder if you can sort of follow up on Kobe's question.
Steve asked the best questions.
Full rate cuts, talk us through the process that you're thinking, or is it just one rate cut? Or are you in the process now thinking that rates need to be normalized here? Thank you.
Yeah, I can't really say that, honestly. We've seen, significant movement in the labor market, and, we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to support the labor market. At the same time, we're seeing progress on inflation. So, we actually got to this, we raised rates a year ago at the July meeting. And if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress, and the labor market, as I think, unemployment was in the mid threes. So it's a different economy. And I think it's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is, that we've had this really significant decline in inflation.
Sheesh.
And unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is, how do we keep this going? And this is part of that. We think we don't need to be 100% focused on inflation because of the progress we've made. 12-month headline at 2.5, core at 2.6. It's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I think most rates, you would think in a base case that policy rates would move down from here, but I don't want to try to give specific, forward guidance about when that might be, because with the pace at which it might happen, because I think that's really going to depend on the economy, and that's highly uncertain.
Rachel. Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. On inflation, do the past few months of good reports look like what we saw last year, where you really had a lot of momentum with a few bumps in between? Would you characterize that kind of momentum as back on track at this point in the year?
Actually, what we're seeing now is a little better than what we saw last year. Last year, as we pointed out late in the year, a whole lot of the progress we saw last year was from goods prices, which were going down at an unsustainable rate, disinflating at an unsustainable rate. This is a broader disinflation. This has goods prices coming down, but we're also now seeing progress in the other two big categories, non-housing services and housing services. So, so the thing is, you've got 1/4 of that. We had 7 months of low inflation. You got 1/4 of this. I would say the quality of this is higher, and it's good, but so far it's only 1/4. So I think we need to see more to know that we're, to have more confidence that we're on a good path down to 2%. But as I mentioned, our confidence is growing because we've been getting good data. And things like the ECI report, and frankly, the softening in the labor market, conditions, give you more confidence that the economy's not overheating. It doesn't look like an overheating economy. And it looks like an economy that's normalizing.
And if we were to think about the first couple of months of the year, is there any sense now that they were these blips that could have actually allowed for earlier rate cuts, as were some of the projections going into
So the
2024?
thing about if what it is seasonality, and it could just be, it's very, very hard to do appropriate seasonal adjustments. If that's what it is, then that actually implies that other months we're under reporting too low inflation. If you smooth it out, it's a zero-sum game. And that's why we look at 12 months. We look at 12 months because that takes all that out, all those effects out. 12-month now is 2.5% headline, 2.6% core. This is so much better than where we were even a year ago. It's a lot better. Now, the job is not done. I want to stress that, and we're committed to getting inflation sustainably under 2%, but we need to take note of that progress, and we need to weigh the risks to the labor market and the risks to our inflation target now more equally than we did a year ago.
Michael McKee from Bloomberg Radio and Television. I'd like to ask you about the balance of risks as the American people see it. At this point, is the risk greater to leave interest rates where they are, given the damage that higher interest rates do to the economy in slowing demand and raising prices? Or is it more important for the American people that you keep rates where they are to bring inflation down?
I think that we've been given an assignment by Congress. This is how we serve the American people, is by achieving maximum employment and price stability, right? And so in our, quasi-constitutional document, the Statement on Longer Run Goals and Monetary Policy Strategy, we look at the two goals, and if one of them is farther away than the other, the two variables, inflation and employment, if one is farther away from its goal than the other, then you concentrate on the one that's farther away, and you take account of the time to reach the goal. So for the last couple of years, the best service we could do to the American people was to focus on inflation. But as inflation has come down, and I think the upside risks to inflation have decreased as the labor market has cooled off. And labor market has softened, probably the inflation is probably a little farther from its target than is the employment, but I think the downside risks to the employment mandate are real now. So we have to weigh all that. And if you think about where that takes us, is we have a restrictive policy rate. It's clearly restrictive. It's been the rate we've had in place for a full year. And the time is coming, as other central banks around the world are facing the same question. The time is coming at which it will begin to be appropriate to dial back that level of restrictions so that we may address both mandates.
Well, you have event risk basically with the jobs report on Friday and another one before you meet again. Are you certain that you won't fall behind the curve and lead to unnecessary unemployment if you wait until September?
Ooh,
Certainty is not a word that we have in our business.
spoken like a true
So,
economist.
we get a lot of data between now and September, and it isn't going to be one data read or even two. It's going to be the totality of the data, all of the data, and not just it. And then
So, look, same as usual. We're talking about being data dependent. He's talking about we're not going to make decisions ahead of time. Your job is to make decisions ahead of time. Now, to give Jerome Powell his credit as a responsible Fed chairman, as a responsible economist, you can't look at individual data points or month-by-month data and then make this big overarching conclusion. You really have to let things play out over a long term because that's how economies are really weighed. And so I do like Jerome Powell's, it doesn't really sound like he's avoiding a lot of these, but it's more of a reminder every time, like, listen, you can't get caught up in one GDP report or CPI report and think that that's going to be the big turn or shift. We have to weigh things out in context.
Well, we'll look at everything. We've seen some tendency to have a narrowing base of job creation in some months going back, but then we've had some months where job creation was broader, and also the headline number of jobs has come down. So but you look at the whole thing, and I think you do look at private demand extra carefully. To your point about government. So we'll just be looking at all those things.
So as a follow then, so could the Fed then be behind the curve? Because you said some of the reports last meeting, you said the reports could be noisy or overstated. Was there a discussion of what kind of discussion was there for a cut today? And could the Fed be behind the curve?
Yeah, so look, the objective is to balance the two risks, right? It's the risk of going too soon and the risk of going too late. We've been, we had 7 months of good inflation data at the end of last year. We said we wanted to see more. We said that we pointed out that too much of this was coming from goods. And sure enough, the first quarter wasn't great inflation data. Now we've got a quarter that is good. And, we're balancing the risk of going too soon against the risk of going too late. That's what we're doing. There's no guarantee in this. It's a very difficult judgment call, but this is how we're making it. But in terms of today, your question about today, we did have a nice conversation about this issue today. The overall sense of the committee, as I mentioned, is that we're getting closer to the point at which it'll be appropriate to begin to dial back restriction. But we're not quite at that point yet. We want to see more good data. The decision was unanimous. All 19 participants supported it. But there was a real discussion back and forth of what the case would be for moving at this meeting. A strong majority supported not moving at this meeting. That was a strong sense of the committee, but it's a conversation that we had today, certainly.
Courtney. Courtney Brown from Axios. Thank you for taking our questions. When the Fed was raising rates, there was a lot of conversation about long and variable lags. I wonder if that applies on the way down too. How are you and the committee thinking about that?
Yes, it does.
Great question.
I think the lags have kind of showed up here in the last 6 months, by the way. You really do now see the restriction. Whereas, even a few months ago, people were questioning how restrictive policy was. Look at the labor market now. You can see, and look at inflation, rate sensitive, interest sensitive spending. You really do see now that policy is restrictive. I wouldn't say it's extremely restrictive, but it's certainly effectively restrictive. Yes, the lag should be on the way down. It should take some time to get into the full economy, affect financial conditions, and that affects economic activity, hiring, and that kind of thing, and ultimately inflation. It's not instantaneous, although it's faster than it used to be because markets move now in anticipation of our moves.
So are you worried then that if monetary policy acts with long and variable lags, even when you're lowering interest rates, it might be too late for the Fed to help stave off any kind of slowdown in the labor market or broader economy?
Yeah, we have to worry about that. Just to make it clear, it's a very difficult, challenging judgment, and we don't want to go too soon. We don't want to go too late. But this is how we've made that judgment. I feel good about where we are. We're certainly very well positioned to respond to weakness with the policy rate at 5.3%. We certainly have a lot of room to respond if we were to see weakness. That's not what we're seeing, though. What we're seeing, look at the first half growth numbers. Look at PDFP at 2.6% for the first half. It's not signaling a weak economy. It's also not signaling an overheating economy. Labor market, admittedly, the unemployment rate has moved up 0.7, and we're seeing a normalization there. But wage increases are still at a high level. Unemployment is still at a low level. Layoffs are very low. Initial claims have moved up, but they're pretty stable, and they're historically not high at all. So the total scope of the data suggests a normalizing labor market. And again, we are carefully watching to see that continues to be the case.
Victoria.
Hi, Victoria Guido with Politico. On the labor market, I was wondering, how worried are you all about unemployment rising to the point where it triggers the SOM rule? And would that potentially affect how quickly you cut rates?
The SOM rule.
So I would just say that the question really is one of, are we worried about a sharper downturn in the labor market? So, and the answer is we're watching really carefully for that. We're aware of that rule, which is really I would call it a statistical thing that has happened through history. a statistical regularity is what I'd call it. It's not like an economic rule where it's telling you something must happen. So again, what do we see? What are our eyes telling us? We look at all the things we're seeing, and what it looks like is a normalizing labor market. Again, job creation at a pretty decent level, wages moving up at a strong level, but coming down gradually. Job vacancies have come down, but they're still high by historical standards. So again, I've been through some of the data already, but what we think we're seeing is a normalizing labor market. And we're watching carefully to see if it turns out to be more, it starts to show signs that it's more than that, then we're well positioned to respond.
Is there reason to think that the labor market might behave differently this time than it has historically?
I think, history doesn't repeat itself. It rhymes. I think that statement is very true about the economy. You never assume it's going to be just the same. An example would be, is there a trend increase in the level of vacancies? There are many, many examples. So it's never exactly the same. Also, let's remember that this pandemic era has been one in which so many, apparent rules have been flouted, like the inverted yield curve for starters. So many pieces of received wisdom just haven't worked. And it's because the situation really is unusual or unique in that so much of this inflation came from the shutdown in the economy and the resulting supply problems in the face of admittedly very strong demand. So the whole situation is not the same as many of the other prior inflation or downturns that we've seen, or business cycles that we've seen. So we're having to learn, we're having to, to be very careful about the judgments that we make, I would say. So we don't assume that these regularities will just repeat themselves automatically.
Amara.
Thank you, Chair Powell. I'm Mara Mokwe with Bloomberg. There seems to be quite a difference between what.
You guys hang in there. This should be over in about 10, 15 minutes. Then we'll do a quick rundown on really some of the main points covered. But more exciting than this is to basically level up your trading. Get yourself to the next step. Click the link in the description. Use promo code FOMC30. And then we'll go through and review the press conference as soon as we're done.
There are conversations with businesses and business leaders and workers and people in the non-profit sector in their districts. But I'll tell you, it's a pretty, the picture is not one of a slowing or, a really bad economy. It's one of, there are spots of weakness and there are regions where growth is stronger than other regions. But overall, it's, again, look at the aggregate data. Aggregate data is, particularly PDFP, private domestic final purchases, is 2.6%, and that's a good indicator of private demand. So we listen to all of that, and it does. I think it's important to listen to anecdotal data and not just look at the aggregate data. Especially, it's very hard. GDP data can be volatile quarter to quarter. So it's just hard to measure economic activity. There are it's just difficult to do. So I look at both, but I wouldn't say that the anecdotal data is uniformly downbeat. It's more mixed.
Thank you. Jolene Kent with CBS News. Chair Powell, thanks for taking our questions today. You have consistently said that the Fed does not consider politics in making decisions. With a possible September rate cut on the table, it would be less than 2 months before the election, and former President Trump reportedly said that cutting rates so close to the election is something the central bank knows they shouldn't be doing. What's your response, and do you believe it's possible to really remain apolitical with a September rate cut?
I absolutely do. And I think it's, first of all, we haven't made any decisions. I would say it this way. Haven't made any decision about any future meeting. I don't know what the data will reveal or how that will affect the appropriate path of our policy. I really don't know. I do know how we will make that assessment. That's what I do know. So if you take a step back, the current situation, again, is inflation has come down much closer to our goal, and that's happened while unemployment has remained low. We're very tightly focused on using our tools to try to foster that state of affairs continuing. That's at each of our meetings and all of our decisions, our focus is strictly on that and really on nothing else, doing our part, whatever that part may be. We're using our best thinking. We're doing our best to understand the economy. We We follow academics. We follow the many commentators who bless us with their commentary. But we don't change anything in our approach to address other factors like the political calendar. Congress has, we believe, ordered us to conduct our business in a non-political way at all times, not just some of the time. I'll say this too. We never use our tools to support or oppose a political party, a politician, or any political outcome. The bottom line is, if we do our very best to do our part and we stick to our part, that will benefit all Americans. If we get it right, the economy will be stronger, we'll have price stability, people will find jobs.
You guys notice how he had to read off of that statement from the lawyers that said, make sure you let them know that the Fed's not a politicized entity. Because I know the Secret Service is under fire. Everyone's under fire right now, and they do not want to get dragged in front of Congress, for having politicized another department of the executive.
The balance of risks and not on anything else.
Just a quick follow-up. Do your economic forecasts and models take into account the two very different economic plans of these two presidential candidates, Harris and Trump? And if so, how?
No, we do not do that. We absolutely do not do that. When we don't know what they're going to do.
He just wants to step out the kitchen ASAP.
And we just can't do that. We basically, we have our forecast. We're not.
You guys know how J. Cole found his way out of the Drake and Kendrick beef? By just minding his own business and just like, I don't know, just skating or folding laundry, whatever he was doing. Smartest thing he ever did. Don't roll around. And so Jerome Powell is being Switzerland right now. He does not want to get clipped for saying something about either candidate or putting his finger on the scale or making it seem like he's giving a political opinion.
Thank you, Chair Powell. Nicholas Jasinski from Barron's Magazine. There hasn't been a dissenting vote on an interest rate decision in some time. If the data do evolve as you expect, if you do have more confidence by the September meeting, do you get the sense that there will be a unanimous vote on an interest rate move in September? Or basically, are there meaningful differences in committee members' assessments of how much more confidence is needed?
So there are always meaningful differences. There are, and we talk a lot before, during, and after the meeting. We do have a very robust discussion of these things. You're right that in most cases, people, if they feel heard and they feel that their position has been given serious consideration, for most people, most of the time, that's going to be enough. There are dissents. That's fine. No one has a veto. No single person has a veto. So it just is a question of who will vote for and against. We've had dissents. We haven't had so many during the pandemic era, and it just may be that we felt more united because we felt under a lot of pressure to get things right. But before the pandemic, we had plenty of dissents, and dissents happen. It's part of the process. There's nothing wrong with dissents. And if it happens, it happens.
Jean. Hello, Jean Young with M&I Market News. Is a 50 basis point cut as a first cut at all likely or even on the table?
I don't want to say, I don't want to be really specific about what we're going to do, but that's not something we're thinking about right now.
Jennifer.
Of course, I haven't made any decisions at all as of today.
Oh my God, bro, he's covering his ass like crazy. He's like, I'm not going to give you a straight answer, but I'm going to give you a straight answer. Like, I understand though it's a sensitive time, especially with market conditions. So he really doesn't want to speak out of turn, but dude, I don't know, rehearse or something.
Well, so, the way the meeting is set up, the first day there's a discussion of financial stability because it's every other meeting we have that. And then we have an opportunity to comment on that. Then we have an economic go around. And then this morning we have the monetary policy go around. And I think in people's economic go around and in their monetary policy go around, people express their views about this. And there's a range of views. People, as you will know from the speeches that they give, people have different ways of thinking about the economy. And so in the minutes, we'll lay this out in a much better way than I can do off the cuff. But there's a range of perspectives, and But I do think that, we're a consensus driven organization. People come together. This was a unanimous decision. And at the end, everyone supported the outcome, including not just the voters, but everyone. So I would also say some people examined the possibility, the case for moving at this meeting. But overwhelmingly, the sense of the committee was not at this meeting, but as soon as the next meeting, depending on how the data come in.
But there is a growing sense of confidence that you could move at the next meeting, assuming
Yes.
inflation comes.
Well, assuming that the totality of the data supports such an outcome, no question that is the case. That as I mentioned, we think that
All right, guys, to be completely honest, I'm about to fall asleep here. We're not going to get a retracement. I'm going to watch the rest of the Fed meeting because I have a few podcasts and things scheduled right after this. So I'm going to watch the rest of the Fed meeting. I'll do a recap probably on tomorrow morning stream. If you guys want to make sure to hit the subscribe button, check us out every morning on YouTube live. But if we're just going to talk about the most important points that Jerome Powell covered before we hop off, there was some numbers that he mentioned, and there was some numbers that they tried to pin him on. So the percentage of like the change in interest rates that they're planning on cutting in the September meeting, 25 basis points versus 75 versus 50. They do not plan on doing any 50 basis point cuts. So we're going to do this little sort of like drip, 25 basis points, 25 basis points. And then at some point, I think they're going to try and normalize it around 3 or 3.5. We're not going to go back to the zero interest rate environment. And so that's kind of out of the question, but we'll cover that. So they tried to pin him on the exact employment rate, the unemployment rate that we need to see in order to trigger a Fed response. Didn't really answer that. So they asked him about the 4% number. So there was 4% unemployment they tried to ask. He didn't answer it. 5%. What else did he say? There was the unemployment. And then he talked about inflation coming back down. So 3% CPI print, definitely headed in the right direction. And then 30% off your seat to the masterclass if you guys use promo code FOMC 30. Link is in the YouTube comments. So that's basically it. Exactly what we expected. He mentioned all the right data points, mentioned that the labor market is still strong, but it's the same thing he always says. And it's the same thing that we do. We're not just looking at the unemployment rate as a metric for the employment situation. What we need is a indicator like the unemployment rate for what's going to trigger a Fed response. Because we can't just be like, well, we're going to take a look at the totality of the data. Well, does that mean, okay, what quits rate mixed with what JOLTS report mixed with what unemployment, mixed with what hiring, mixed with what open jobs report do we need to see? Like, what's the combination here? Do we need to see more open jobs with less hires, with more quits in this kind of combination? What are we looking for? And as of right now, I don't know what the Fed's looking for. I know what I'm looking for as an economist, but I don't know what the Fed is using as an indicator, because that's our early warning sign. That's the smoke signal for market changes. So kind of the most ambiguity, the most ambiguous Fed meeting I've ever seen. Jerome Powell basically spoke in innuendos the entire time, used his favorite catchphrases like, we're going to be data dependent. We haven't made any decisions on future meetings. When asked about the few of the FOMC members that have dissented, meaning they've written pieces in their own kind of like, to their banks and to some other folks about a different opinion than what the Fed decided. Maybe some folks wanted to cut rates early. Maybe some folks don't want to cut at all. And he basically just said, we welcome dissent. It's okay if they do, but I get the final say, right? There has to be not a unanimous, but there has to be a majority vote in the FOMC for a rate decision. And then Jerome Powell ultimately does get the final say as the chairman. So yeah, all in all, September meeting, probably going to get a cut unless something else changes between now and then, which the way the world is going, anything could happen. So very bullish on this. I don't see any other way around it. As long as we continue to get good earnings reports, then this is just going to be fuel to the fire, and we're going to continue this bullish rally. So tomorrow morning, we're going to show up, we're going to wake up, and we're going to buy. And we'll see how the market looks tomorrow morning when we show up. Said, here comes the sell. Well, I'm personally not shorting, but I am waiting for this retracement to push all the way down. So essentially, it's the same thing, right? Unless I don't want to trade against the rally. That's the reason why I don't want to, you know. Okay, FOMC 30 link is in the YouTube comments. Make sure to drop a like and subscribe. Catch you guys tomorrow. Peace.